Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by Oppenheimer Funds. Oppenheimer Funds has nearly 50 years of experience investing beyond borders to find tomorrow's opportunities. Find out more at oppenheimerfunds.com/global. Christine Ben's Portfolio Makeover Week is coming this fall. To be considered for a portfolio makeover, email portfoliomakeover@morningstar.com. Include your age, life stage, and some details, concerns, and goals for your portfolio. This week on the podcast, 3 funds that recently joined the GoldRated Fund Club, a powerful merger with CVS-Aetna, a foreign large growth fund on our radar, value in big tobacco, an undervalued narrow-moat utility, and healthcare shocks in retirement. Let's get started. Here are 3 new gold-rated funds.
Hi, I'm Susan Jabinski from Morningstar.com. It isn't easy for a fund to earn our top Morningstar fund analyst rating of gold. Funds that do so are best in breed, models in their respective categories. In fact, fewer than 200 funds across dozens of fund categories earn gold ratings. Here are 3 funds that recently joined the GoldRated Fund Club.
Fidelity Extended Market Index is a great option for investors looking to round out a large cap equity position. This fund invests in nearly all investable U.S. stocks outside of the S&P 500. That means that it does own small and micro-cap stocks, even though it lands in Morningstar's mid-cap blend equity category. Because it does own smaller cap and micro-cap stocks, this fund also carries a little bit more risk than the average fund in the mid-blend category. But its broad diversification should help it mitigate risks of single stock or sector exposures. Also, this fund is the cheapest of its kind. It only charges 5 basis points per year, which is much lower than the mid-cap blend fee average. All said, this fund earns a Morningstar analyst rating of gold because it's cheap, broadly diversified, and it has a soundly constructed index.
Things turned out a lot better than many people expected after PIMCO legend Bill Gross stepped down from that firm and gold-rated Harbor Bond in late 2014. Gross had built a powerhouse organization full of top-notch managers and analysts, though, very few of whom followed him out the door, and several of whom had already either been candidates or winners of Morningstar's Manager of the Year award. When Gross left, the firm appointed 3 of those managers to run its total return strategies, including this one, and made PIMCO income manager Dan Iveson chief investment officer. Scott Mather, Mark Kiesel, and Mihir Wora have been running the fund since Gross left. Like most of their peers, they've stumbled here and there, but have otherwise produced a very good record. They've done it with standard PIMCO methods, which include developing macro decisions in the firm's investment committee. The fund's managers then look to PIMCO's vast fundamental research team, which covers just about every security type, sector, and geography. They put those inputs together to fill out their total return style portfolios. That last part is notable because the team runs this portfolio for Harbor right along with PIMCO's flagship total return fund. The biggest difference is that Total Return offers institutional shares that are a little cheaper than Harbor bonds, but which you can only purchase if you've got at least $1 million to put to work, or can access through a third-party advisor or 401k plan. For the rest of us, Harbor bonds, $1,000 minimum, no-load shares are a great option.
Big changes have come for Artisan Global Value. The management team has been separated between Dan O'Keefe and David Samra. Those two have been managing both Artisan Global Value and Artisan International Value together for years. But the two are splitting. They will run 2 separate teams, one for Global Value, one for International Value. And in the case of Global Value, that team will now be led by Dan O'Keefe. And this change was made for a variety of reasons. One was because I think the team was worried about retaining talent. Losing senior analysts who had been with them for years. So really this was a chance to provide promotion opportunities for some of their top analysts. In this case, that is Justin Bandy and Michael McKinnon, who have become co-managers on the fund. Now also, David Samra and Dan O'Keefe have formed separate legal entities as well. This creates far more flexibility in terms of how they can manage their funds. That is, there are no restrictions on how big their positions can be, or at least there are far fewer restrictions on how big an individual stock position can be, since these 2 portfolios are now completely divided legally. So really, it comes back to them, an opportunity to both have more independence, have more flexibility in terms of how they invest, and finally, the opportunity to promote some senior personnel. So hopefully that will lead to continuity down the road for this gold-rated fund, Artisan Global Value.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, CVS is undervalued and underappreciated.
Over the last handful of years, there's been a major trend within the healthcare services space between the major conglomerates that occupy the supply chain. Currently, we have CVS looking to purchase Aetna, and we have Cigna merging with Express Scripts. We believe these two deals are significant and could provide significant returns for investors over the longer term. These key pieces of the healthcare services supply chain will combine into one company that will provide several services on several different fronts for major constituencies within the healthcare space. Right now, we would like to highlight the CVS-Aetna merger as being a key piece of this strategy or key piece of this trend. We believe the new company will be a very powerful player as it will combine retail pharmacy, PBM, and health insurance into one company. We believe the invested capital returns will be significantly above the weighted average cost of capital for this company moving forward, and as a result, we believe CVS is underappreciated and undervalued at the moment.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Chautauqua International growth is on our radar.
Although Chautauqua International Growth only launched in 2016, lead manager Brian Beatner has successfully executed the strategy through a separate account, Baird Chautauqua International Growth, since 2006. Beatner launched the strategy while at TCW Group, where he worked under veteran investor Glenn Bickerstaff. In 2009, he took the record with him and founded Chautauqua Capital Management. The firm was acquired by Baird in 2016, but is still run autonomously. Beatner, now backed by a team of 5, which includes 2 former TCW colleagues, continues to seek companies with sustainable competitive advantages that can benefit from long-term trends. Expect volatility here. The portfolio is concentrated with just 30 to 40 stocks, and Beatner doesn't mind paying up for firms with his preferred characteristics. Indeed, since the fund's April 2016 inception through August 2018, it's at a higher standard deviation than the foreign large growth Morningstar category average. However, investors have been well compensated for that risk. The fund outperformed its typical peer on a total and risk-adjusted basis during that time. While fees are above average, they stand to come down as assets grow. This fund is on our radar.
This podcast is brought to you by Oppenheimer Funds. Oppenheimer Funds has nearly 50 years of experience investing beyond borders to find tomorrow's opportunities. Find out more at oppenheimerfunds.com/global. Now, we lowered our Moat Trends for these tobacco firms.
We've lowered our Moat Trend ratings for British American Tobacco, Imperial Brands, and Philip Morris International to negative from stable due to the evolution in the market for next-generation products. Initially, we had assumed that the cigarette brand equity of tobacco manufacturers was transferable to next-generation products, and early signs supported our assumption. But recent evidence suggests otherwise. Greater adoption of cigarette alternatives now seems more likely to erode big tobacco's cost advantage, pose risks to margins from volume declines, and hit overall returns on capital. Although we have become incrementally more concerned about moats and margins in the tobacco space, we still believe in big tobacco's wide economic moats. Though it may seem counterintuitive in a declining industry, we have conviction that our wide moat ratings are appropriate because we believe big tobacco is very likely to continue generating excess returns on invested capital for the next 20 years. Cigarette pricing remains strong, and most markets have headroom for multi-year price increases that should more than offset volume declines. The market appears to be pricing in a dire scenario for the industry and is far too pessimistic in our view. In fact, we think there's value in tobacco stocks today. Our current picks in the market are Imperial Brands and Philip Morris International. Both of these low uncertainty stocks are trading at a greater than 20% discount to our fair value estimates.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, First Energy looks undervalued.
Over the past couple of years, the market has not been kind to unregulated power plants, or what is referred to in the industry as merchant generation. Weak electricity demand, Falling natural gas prices and tremendous growth in wind and solar energy has squeezed margins. FirstEnergy eliminated its merchant generation exposure by separating from its unregulated unit FirstEnergy Solutions, or FES, earlier this year. Without the support of its parent, FES immediately filed for bankruptcy. To avoid years of litigation, FirstEnergy settled with FES creditors with guarantees and payments totaling roughly $2.7 billion. The market applauded the move, and the shares have been one of the best performing utilities in 2018, with a total return over 22%, double the S&P 500's total return. Even after this year-to-date performance, we think the shares remain undervalued. We believe the market fails to fully appreciate the company's ability to invest over $2.5 billion per year in its wide moat transmission business, which provides an almost guaranteed economic benefit to shareholders, and narrow moat utilities in constructive state regulatory environments, which together will account for 90% of earnings. We believe solid earnings growth and a growing dividend will be the catalyst for the market valuing FirstEnergy shares more in line with its regulated utility peers with economic moats.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Finally, David Blanchette on healthcare shocks and retirement.
Hi, I'm Christine Benz from Morningstar.com. How do healthcare shocks affect retiree spending? Joining me to share some research on that topic is David Blanchette. He's head of retirement research for Morningstar Investment Management. David, thank you so much for being here.
Thanks for having me.
David, the retirement planning community is increasingly thinking about the role that healthcare costs play in retirement planning. Let's talk about the latest data runs. I know Fidelity annually puts out some data about healthcare spending for couples who are age 65. What does that look like in aggregate?
Well, it's pretty scary. I mean, Fidelity's is about $250,000.
Yeah,
is the cost of
even higher.
Right. I mean, others, will say up to say $400,000. And so, if you just look at healthcare, medical expenses, retirement, it's a pretty scary number.
Okay. The thing is, though, when you look more closely, you see that these healthcare costs vary hugely by household. Some households have giant out-of-pocket outlays, and some households have less. How should retirees approach that fact?
Sure. So most healthcare expenses are quite known. It's things like Medicare premiums.
Right.
Okay. I think the scary item is things like nursing home stays or home health stays, things that require this significant unexpected out-of-pocket cost, and that's really hard to plan for. And so when I think about things like that, I often think that maybe home equity is the asset of last resort should that event occur.
Okay. So let's talk about how these costs can affect retiree spending. Certainly if you have some big healthcare shock that has implications for your overall spending. But I guess the thing you examined in the paper was whether it had repercussions for spending in other parts of the budget. What did you find?
Right, so the question I looked at was if you have a household that experiences a health shock, and so this is not going to be a Medicare premium, it's an unexpected health expense. What happens in the future? And so does that household, if you compare future expenditures, spend less than they did before the health shock or less? Because in theory, maybe expenses rise because they have additional health expenses.
Right.
Maybe they fall because they kind of adapt. And what I find is that the larger the expense, the more future expenses fall in retirement. And what we're seeing then is that households kind of adjust their spending based upon this expenditure. And so to me, it just suggests this idea that households experience this large health shock and then spend the same or more in the future doesn't tend to hold, at least on average.
Okay. So the question is, are households that experience the healthcare shock reining in spending because they want to or because they have to because they feel the budget crunch?
So that's a great point. So if you look look at different types of spending. There's, you can look at total spending or discretionary and non-discretionary. Where you see almost all the reduction is in the discretionary spending. There wasn't a significant reduction in non-discretionary spending. So if you have to, you have to pay your mortgage, you have to pay for other things. But in those areas you can control spending, that's where it declined the most.
Okay, and this follows on some research that you had done more broadly about retiree spending, where you actually looked at trends over the retirement life cycle and found that across different income bands, even for people who had great financial wherewithal, you did find some tapering off in spending toward the middle part of retirement. Was that right?
That's right. And so what's interesting is again, this was the same data set. Almost every household, about 3/4 of the households, had lower consumption in today's dollars over time. It was those households that had the higher shocks that even reduced by more.
Okay, and that's where you wound up with that, what you call the retirement spending smile. So
right.
Higher early on, sort of tapering off and then back up, but only for some households.
Right. If you can live that long. That's
okay,
right.
So the question is, if I am a retiree attempting to get my arms around this issue and factoring in healthcare expenditures, potential shocks in my plan later in life, how do I do that? How do I embed some safeguards in my plan to guard against these big healthcare shocks?
So there's no easy answer to that question.
You mentioned home equity.
I would say that home equity is one. I'd say that, to me, a bigger issue here is, those numbers that come out by Fidelity and others, they're good to know, but they're really scary.
Yeah.
And my perspective is we don't calculate the value in today's dollars of what your food's going to cost, what your home is going to cost, what your education, whatever you're spending money on is going to cost. And so to me, healthcare is one part of a much larger puzzle, okay? And if you have a healthcare expense, if it goes up, you can usually spend less somewhere else. And so I'm not saying don't worry about it, but kind of view consumption and your spending collectively, and then, have things like home equity things happen to pay for those things as they come up.
I guess another point is that healthcare expenses aren't a brand new cost for most of us in retirement, that we've been shouldering them, but maybe through our paycheck deductions while we were working. So it's not this brand new cost that we never had before.
Right, and one thing that I think is really uncertain is what will happen 20 years from now. And so I think that we have a pretty good handle on where Medicare premiums are going maybe next year.
Right.
But there is this uncertainty. What will happen if healthcare costs keep rising by 7% a year? And I don't know how to answer that question either. But that is something to be aware of for someone thinking about, well, how much do I save for retirement? How do I save for retirement? And things that's where things like HSAs are very valuable, because it can help someone prepare for retirement in a tax advantage way to help fund those healthcare expenses.
And you mentioned inflation. I guess that also calls for embedding some inflation protection into my portfolio plan as well, right?
Right. Assets that track inflation better, like tips or real estate, really are more attractive investment options for someone who's in retirement versus someone who is, say, much younger.
Okay, great research, David. Thank you so much for being here to discuss it with us.
Thank you.
Thanks for watching. I'm Christine Benz for Morningstar.com.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.